Hi everyone, thanks for joining us. Today I'd like to introduce Ian Leslie, who's the Head of Business Development for Aon. Ian, thanks for coming down and making, by all accounts, a rather empty train journey down from Birmingham this morning.
It was. I had a carriage to myself, which is slightly surreal, but given the times, I suppose it's the new normal.
I guess no one's got the back to work memo quite yet, or certainly not for, for central London commuting.
No, and certainly not at the train time that I was on this morning. So
I appreciate it. Thanks for making the journey. You and I speak on a relatively regular basis, and I guess a subject that comes up an awful lot, more from you than from me, is zombie companies. So I know you've got a few things you want to get off your chest, and I thought this would be a great forum for that to take place. So I guess if you want to start by explaining what a zombie company is in a technical sense, and really just the floor is yours.
Yeah, sure, and I'll be as technical as I can be about it. Look, the term zombie company is one that most people have heard of these days. Apparently it started in 1987 with the US banking crisis. Grew popularity, really, for us in kind of Western Europe. It grew in popularity with the financial crisis and became a term used to describe a business. I think the technical term is if their ICR, so interest cover ratio, is at 1. So it's a business that is alive, but barely. So there's two real definitions. There's the narrow one, which is the ICR, as I mentioned a second ago. And then there's a wider definition, which looks at how much a business is investing, whether their revenue is stagnating, so what the revenue trend is, their cash flows. So it's one of those where it's a term that lots of people use, but actually the definition of it kind of depends who you're talking to. But it definitely is something that's worth our conversation today, put it that way.
And is it worth our conversation today because obviously post-pandemic we're in a very different world than we were a year or two ago now, or is this something that's just been sort of bubbling away in the background anyway?
Yeah, I mean, it wasn't caused by the pandemic. This is an issue that's been going on for a while. So we saw it in the financial crisis, it kind of went away for a bit, and then it started to grow. Back even in 2019, KPMG were estimating that 1 in 7 businesses globally were in a zombified state. And what the pandemic has done is exacerbated that situation.
Right.
So a think tank in the UK called Onward did a load of research to see what effect the pandemic had had on the numbers. And what they found was that 1 to 4% of new businesses have gone into a zombified state, which takes the total in the UK to around 20%. So if you think of that as 1 in 5, it kind of shows the gravity of the situation. So it hasn't been caused by the pandemic. It's definitely been exacerbated and made worse by it.
Sure. And I guess as you see it in your role, which is sort of in a credit and insurance role, this is a real risk to you guys. This is a risk that you're looking at daily across sectors. This isn't just isolated. Obviously, we know that travel has been brought to its knees, but it's not just that. You were saying earlier as we were having a coffee that this is really, UK-wide.
Yeah, it is, and it surprised me actually how many sectors it's across, because you kind of know the sectors you expect to see it in. Not just because they're the sectors which tend to have the higher amount of claims anyway, but these are sectors where we know there's been a lot of volatility, where they've been massively impacted by the pandemic through no fault of their own, but just the way it is. But it actually surprised me how many sectors it's across. So you've got automotive, obviously travel, as we said, but you've got energy, utilities, telecommunications, media. It is a global, if you want to, I don't use the term pandemic, but it's across all sectors, so it isn't just isolated to kind of one area.
Sure, and I guess I'm sitting here thinking, well, actually, I've got clients in all of those spaces and plenty more as well.
Yeah.
Not the first time I've heard zombie companies, not just from you, but in the press as well. And I guess the knowing about something and acting on something are two very different things, and almost I get the feeling that perhaps the situation is diluted by the press coverage sometimes, in as much as you can just go, okay, is what it is. But actually, in real terms, if it's 1 in 5 companies that have got this, then surely there are some red flags, some signals, some steps to be able to take to go, okay, who are my client base? what position are they in, and what do I do about it, really?
It's a good question, because there's a couple of ways that you can protect yourself. And first and foremost is around investment in your credit management team. The job of credit manager has never been harder than it is today. It's always been tough, but now to get to the same decision they would have come to back in 2019, it's going to take them longer. They've got to go through more things. It's just a longer process and a tougher process to get there. So making sure that your team is resourced properly is really, really important. Regardless of the other things I'm going to talk about, that's number one on its own. So number two is around the information. Not only is it harder for the guys to go through it, but actually getting access to the information is that much tougher. I mean, we're lucky in the UK, a company's house has a lot of information already there, but because of the pandemic, it's just not as useful as it was back pre-pandemic. So it's about getting up-to-date, relevant financials. And that's management accounts, that's cash flow forecasts, and that really comes from one or two routes. First one is knowing your customers and having a relationship with them to be able to talk to them and ask them and explain why it is that you want that information. So not just a case of kind of asking for it, explaining the rationale behind why it is you're asking for it, what the impact is if you don't get it. Because nobody wants to look at shortening payment terms, but that is obviously another step you can take. And then and I wouldn't be doing my job without saying it, but then there's other access to information through things such as credit insurance. And that can be a really useful way of getting financials and information on businesses that you just wouldn't be able to get normally.
Sure. I guess, I'll play devil's advocate to a point here. But you get all the information. If you've got the relationship with the client, great. And if they've got the data that's forthcoming, wonderful. Yeah. You're processing that data, and actually you don't like what you're seeing. Now, from a sales guy's perspective, I'm sure that's the worst thing ever, because you are going to want to cut terms, reduce limits and things like that. Yeah. But also from an insurance perspective, if you're seeing that data as well, then it's going to be potentially harder to write a policy on that individual. So is there a way of overcoming that, or is that just actually what we're facing and something to be mindful of?
Yeah, it's a really good question, because credit insurance always gets a bit of a bad rap for being there until it starts raining and then the umbrella gets taken away, which if someone who's been in it for a number of years now, I can say is not the case. But obviously the insurers, like the companies, they're not there just to take on risk and take losses. It wouldn't be a very good business model if they did. So you're right, if the business starts to downturn rapidly enough or severe enough, the insurers may look to remove their position. But that doesn't mean you lose the information. So you can still, in terms of risk, if you can't transfer it and you can't avoid it, the best thing you can do is understand it. And that really comes from that information piece. So even if you're in a situation where a limit maybe gets withdrawn or reduced, it doesn't mean that you're not going to keep the information flow with the insurer. And it's worth remembering that information for insurers is their lifeblood. It's what they live off. And the worse the company gets, the more the insurers are going to want to know what is the latest state of play, because they're conscious with every decision they make. They don't want to create self-fulfilling prophecies, but they also don't want to take losses that they shouldn't do. So it all comes back to the information piece.
Yeah, well, I guess that is the thing, isn't it? Because as you said, self-fulfilling prophecy feels to me like, well, actually they're not insurable, or I can only insure them for a very low limit. Therefore, I'm going to have to reduce my terms. Yeah. Therefore, they're going to be more cash constrained because they're going to be paying early, which in turn is going to hurt the new financial information that comes out, which in turn is going to turn the insurers off, etc. Yeah. So I guess potentially you're actually risking digging someone deeper into a hole through the insurance piece, let alone when we talk about interest rates potentially rising and things like that. So of the pitfalls that you see over the next pass on when the pandemic's going to end, but as we emerge from it, and let's big assumption that there isn't future lockdown or aren't future lockdowns, yeah, exactly, yeah, fingers crossed, but pass, I think Sajid is pretty keen that there won't be. But yeah, yet to be proven. In terms of the next 18 months, 2 years as a timeline, how does this evolve as people start to think about interest rates potentially rising, bounce back loan schemes potentially needing to be repaid? Are we looking at the start of an avalanche?
Yes. The question to end all questions
there we go.
Is get my crystal ball out and predict the future. So if we go back to when the pandemic first started, I'm not an economist, but all economists thought there was going to be this wave of insolvencies. And why wouldn't you when, let's be honest, the economy was closing down? So it would lead to make you think that if there's no revenue, that businesses aren't going to survive. Obviously, the government stimulus came in, we had the C-bill scheme and all those sorts of things, and whether, you think there was enough or too little investment, the reality is that investment staved off that, that kind of raft or tsunami of insolvencies, whatever you want to call it. But what we're now left with, rather than impending doom, which is what we had back in kind of 2020 when all these stimulus schemes came into play, is we've now got unknown future volatility, all those things, unpredictability, everything that you don't really want when you're trying to manage risk. We've got that now because no one really knows what we're going to go back to. You obviously mentioned around interest rates. That's almost seen as a bit of a dirty word at the moment, but we don't really know what it's going to look like. We don't know how much they're going to rise by. We'll assume they're going to rise, but don't quote me on that because I'm not an economist. But it looks like they're going to. So it depends what impact that has on the bottom line. And then you've got things around lockdown economics at the moment is a term which a lot of people are using to describe the way in which we're spending currently, whether that's through forced decisions or unforced. The question will be, when we reopen, how much of it was personal choice and how much of it was because we were told to do it? So there's going to be a lot of businesses out there that are trying to forecast turnovers and they don't really know what their consumers are going to, what their customers are going to do. So volatility is going to be massive. And I sound like a stuck record, but it just comes down to knowing your customer base and doing what you can to protect. I mean, I know me and you obviously were talking earlier, but one of the things that I don't like with our industry in terms of credit insurance is it gets called bad debt protection, which I hate, because for me that's the wrong way round of looking at things, because that's basically saying I know it's going to happen, so I want to protect myself when it happens. Whereas the way I see it is it's about opportunity protection, because it's doing what you can to grow your business and grow sales safely with knowing that you've got that safety net and that protection and that information. But it's about avoiding a bad debt. It's not about the insurer paying it out when it happens. Yeah,
it's interesting. I mean, from a risk perspective, we see it obviously in the FX markets, and we would say, one of the biggest unknown costs will be the cost of your foreign exchange rate, unless you've got it locked in. So it's not about thinking, oh, it's going to go down, I need to get this protection in place. It's about, this is where I know I'm doing business. This is the comfort that I've got my margin should things turn south. Yeah. But then let's go and drive the business forward. To your point on sort of the amount of information that I'm guessing everyone is starting to share and is being gleaned from this, I think is an interesting opportunity in a lot of sectors where actually you may be in a zombified state as a business, but if your input cost is lower than your sales price, you've probably got a viable business there. And I think, again, interest rates are still low, money is absolutely abundant, and I just wonder whether there's a consolidation play for other businesses that are slightly more ambitious about the sector or the space that they're in, thinking, well, there's an opportunity there to add a product line, add a customer base, add something to my business that I'm seeing from a business that may be not in as great a shape as I am, and whether the owner of that zombified business could be thinking, well, actually, I'd rather take 80p on the pound than bring in some of your friends in the claims department, as it were.
Yeah, and that's where when people think of zombie companies, it kind of goes hand in hand with the term. They think poor business. It doesn't mean it's a poor business. It just means it's in a poor state right now. But you're right. I mean, if there was a way of consolidating through mergers and acquisitions, a couple of zombie companies together, and then lowering your cost base, you can turn what looks like a dying business, if you will, into something which is profitable, growing, ability to invest. The risk from an economic standpoint is if the problem around zombie companies gets worse, so if the number is allowed to continue to grow. Because there is and the correlation between the number of zombie companies in an economy compared to the amount of investment that happens, people have got different opinions on how much it correlates between the two, but the one underlying factor is that there is a link between the percentage of zombie companies as a percentage of the whole within an economy and how much investment happens. So there is a risk if we don't do something about it, or if it's allowed to get worse, is that you start seeing lower productivity, job losses, all these sorts of things, which obviously we don't want.
Well, I guess normally I'd say that market forces would probably come in, and yes, there would be some consolidation, there would be some wastage, but that whole proposition is so heavily skewed now by the government's intervention, and entirely justifiable and great intervention at the time. But there is going to be the knockout, and I just wonder what the timeline is going to be, whether it is hypothetically 18 months, 2 years, or things happen a lot quicker.
Yeah, and then, no one wants to hear me say this, so I'll apologise to everybody in advance, but the risk of further lockdowns, I mean, it's what none of us want to think about or say, but the reality is when they introduce a traffic light system, the reason they introduce a traffic light system is so it can go up and down, and we may get to green where everything reopens, but there's always a risk that you go back to amber, and obviously, touch wood, fingers crossed, all the rest, that we don't ever go back to full lockdowns.
Sorry, this is recorded on a Monday morning, so thanks for that bright start to the week. Yeah, this is only going to be one-way traffic, and summer holidays are going to come on, and it's coming home at this point as well. So there's still a lot to be optimistic about.
An ex-accountant who works in insurance, optimism and stuff, probably not in my DNA, so I apologise for that. But it just shows a level of volatility that's there. But yeah, it's...
So if you were to give perhaps one or two, maybe even three, practical tips. So I guess almost any business, as you said, this is sector agnostic, and there'll be so many businesses that are looking to bounce back, to recover, to gain new clients. What are sort of the top tips, if you like, to make sure that you can do business with limited risk?
Okay, so talked about investment in your credit management piece, so we'll kind of park that to one side. I think the first thing is understanding your book. So if you've not done that already, the first thing you need to do is work out of your customer ledger, sales ledger, whatever you want to call it, what percentage of your customers are in this state. Whether you use the wide definition or narrow definition, doesn't really matter. Do the analysis to work out of your book how much of it you think there is in this kind of zombified state, or it may even just be in a sector that you believe has still got a chance of being impacted going forward. Because then you can work out the size of the problem. Because for some people, you might be dealing with lots of business in this state. Others, you might be fortunate, you might not be dealing with any, and therefore, maybe you don't need to take the severity of steps that we're going to talk about. So I think knowing your ledger is really important, and your customers within it. And the other two pieces, one, I do think protection is key, and obviously I'm maybe slightly biased in that in terms of saying it, but there are other ways of protecting it. It doesn't have to be credit insurance there, and there are bank guarantees. There's other ways of doing things in terms of protecting your position. It may be being more stricter with your credit limits with customers, but that obviously has a negative knock-on effect. So find some way of protecting yourself, and that's dependent on the risk you're willing to take as a business. And then in terms of the last piece, it's just reviewing it regularly. I know with IFRS changes, there's a lot more focus now on your bad debt reserve at the end of the year, and whilst it's an annual thing, the more regularly you can review your customer base, the better right now, because it's going to be so volatile, there's going to be so many changes, whereas you might have got away with reviewing a customer once every 12 months in the past. Now I think it needs to be a quarterly review, even if it's just a stamp in the box to say, yeah, they're fine, same again next quarter, and that's why I keep coming back to that resource piece, because it is your best protection is knowledge, 100%.
Well, I mean, that seems like the perfect opportunity to end this. Your best protection is knowledge. Ian, thanks for coming down and making the journey. It's appreciated. No doubt see you again.
Yeah, thanks, Mark. Thanks for having me.